It's my pleasure to welcome our panelists to this virtual session of the Euromoney ECBC Covered Bond Congress 2020. Today we have two guests to discuss what the picture looks like for syndication and trading in the covered bond market in the wake of the coronavirus pandemic. I'd like to remind anyone listening that they can type in questions via the chat function throughout the session, and we'll be able to pick those up and answer them along the way. Our first speaker is Henrik Stille, who is a portfolio manager at Nordea Investment Management. Hello, Henrik.
Hello.
And our second speaker is Julien Marchand, who is the head of Origination for Financial Institutions and SSAs at NordLB, and he's also looking after the syndicate team there. Hello, Julien.
Hey guys, hi.
So if we take the height of the COVID crisis as having been in March or April time, we've now had several months in which conditions have really started to settle in the financial markets. Clearly, though, that initial period of stress has brought about a lot of cause for reflection. And the measures that we've seen taken by governments and central banks have had a profound impact on the outlook for covered bonds. So there's plenty to talk about here today. But I'd just like to start off by asking about liquidity. And I wanted to ask, to what extent did we see liquidity dry up in the covered bond market in the first throes of the crisis? And how far, if at all really, has it come back in recent months? Perhaps we could start with you, Henrik.
Yeah, of course. I think, if we look at the covered bond market today from a liquidity perspective, I think we are all the way back to where we were before the outbreak of the corona crisis in March. So right now, I think the markets are functioning very well. And then, of course, we had a few weeks there during the peak of the crisis when liquidity dried up. So it was of course, difficult to trade during these weeks, but it was also a very short period of time where this was an issue. And then also, it's always important also to compare to, the other asset classes. And if you compare covered bonds, even at the peak of the crisis, if you compare covered bonds to other credit bonds, the covered bond markets, they worked much better even during the peak. When I spoke to my colleagues that trade other credit bonds in the weaker capital classes, then you could almost not trade them at all, and if you were going to trade them, it was many price points away from screen prices, and it was never that bad in covered bonds. I think actually we traded covered bonds every day, even during the peak of the crisis.
Wow. Okay. So the impact on covered bonds was quite muted, but also quite short. It didn't last very long, and things moved back quite quickly. Is it?
Yes, definitely. It also moved back due to the, very fast response from the central banks and the authorities. The liquidity also came back very quickly. And as I said before, today, I think we are back at where we were before the crisis, or maybe even a little better compared to prior to the crisis.
And what do you make of that, Julien? So liquidity was disappeared for a few weeks, obviously at the height of the crisis, as perhaps we might expect, but the covered bond market's really come back in the last few months, and now liquidity may be even better than it was before.
No, fully agree with the view that Henrik just shared. Yes, I would say that during the peak of the crisis, maybe the screen prices were really accurate. I think that's certainly one factor that you usually have in crisis, that it's difficult to find the right price. But yeah, I think markets returned. I think one advantage certainly of the covered bonds, at least for the eligible countries, is that you always had the ECB in the market, which try to, if there are any bonds available, to get their hands on. that's certainly a factor which helped in this respect the covered bond world to be more solid than other asset classes, as just Henrik mentioned. On the other hand, of course, with this big player in the market, I think the liquidity in normal times is not comparable to other asset classes. But nevertheless, I think we are back there where we used to be before the crisis. And at the end of the day, I think we are talking here only about a few weeks where you had some distortion. And as well, I mean, we don't only have to say look on the secondary market as well in the primary market. I think the covered bonds, if I look back before the summer break, I think we only had 3 weeks maximum where you don't had any primary issuance in the Euro benchmark space. So that shows as well how solid this asset class is at the end of the day.
Yeah, absolutely. And I mean, we're talking about covered bonds as an asset class, but has that recovery and the sort of accuracy of prices on screens, is that reflected across the market for all parts of the covered bond market, or are there pockets that perhaps haven't recovered or perhaps even doing better in terms of liquidity?
Well, difficult to say, but I think we are really back there where we used to be finally. So
sure.
I think you can say that I think, I mean, from my perspective, I think that the liquidity is better in all the jurisdictions where the ECB is active. And also within each jurisdictions, I think the liquidity, at least the liquidity on the bid side, is not as good in those names that are not eligible for ECB purchases as the names that are eligible. Even within jurisdictions. Then, of course, the AAA jurisdictions that are not eligible, like Canada and Australia, they are fairly liquid anyway.
Absolutely. Okay. Well, the role. I mean, I would like to ask about the role of the ECB, because clearly the ECB has been a big part in the secondary market, well, just in the market generally for covered bonds for a number of years now. But following the initial sort of period of dislocation this year with COVID, the ECB has obviously made a number of decisions to increase some of the sizes of its purchase programs and perhaps play a bigger role in the market. Has that been what kind of impact has that had on covered bonds? Do you think that some of the changes that the ECB has made to its purchase programs have they changed the backdrop for covered bonds, or is it more of the same? I suppose back to normal.
In my view, I would say even with the additional measures they put into place, I think the impact on covered bonds is limited in my view. I think you can see it as well in the figures that the portion which is bought through this, through new money or through this new funds doesn't play a big role. I think the CBBB3 that they introduced already a few years ago, I think that's an important factor at the moment. I think the additional money, that was certainly helpful for the confidence of investors, but I think it plays a much bigger role in other asset classes than in covered bonds.
Okay, yeah. And would you agree with that, Henrik? Is that?
Yes. I think it plays a much bigger role in other asset classes, definitely. And I think also it's on the offer side. I think there, if you can see the difference somewhere, it's on the offer side where it's, I mean, due to the ECB's large purchases now since the outbreak of this crisis, it's difficult to find large offers. If there is a specific bond you like to buy, then I mean it's usually difficult to get a large offer in that bond. So instead we need to work our way around it by finding substitutes or looking for covered bonds in other currencies than euros where the ECB is not active.
Okay, and that's become, so has that become worse in recent months, or has that been a longer standing theme?
No, but I think that's been a longer standing theme since the ECB they launched the QE program. So I don't think it's not something new.
Absolutely. Okay. Well, I think one thing perhaps that is clearly going to impact liquidity and perhaps has changed a bit more then is just the amount of supply that we're expecting in the covered bond market. So some of the factors that we've that have taken place over the last few months seem to have really limited the outlook for supply in covered bonds. And depending on where you look, I think some analysts are quite dismal about the expectation for what levels of supply will have, and what kind, and just how negative it will be in net terms. I'd just like to ask you both what you're kind of expecting. What's your sort of outlook for issuance over the next few months, and how's that changed during the pandemic?
Yeah, sure. I mean, I think it's not a special pandemic thing. It's the TLTRO3, which replaces a lot of issuance because you get cheap money. It's for 3 years. So for a couple of issuers, it fit pretty good under LN perspective. And yeah, I mean, I don't know if you can call it free lunch, but you get money much cheaper than you could get at the capital markets at the moment. And therefore, yeah, I would agree. The outlook for issuance in the second half of this year is limited. There will be certainly issuance. I mean, we saw just this week or just after the summer break with Berlin Hyp, the first covered bond transaction. But for most of the issuers I hear, yes, there could be some covered bonds, but only much less than we were forecasting at the beginning of the year. Plus another factor that you have for some of the issuers which are not located in Euro countries, that their domestic funding base is offering quite attractive funding opportunities as well. So this factor, again, will reduce the benchmark funding, at least in Europe. And therefore, from a fundamental perspective, that should support covered bond spreads in the future, given that the issuance outlook, at least for 2020, is limited. There will be some issuance, but not as much as forecasted at the beginning of the year.
Absolutely. Okay, so TLTRO is really the big factor.
In my view, yes.
Yeah, we saw how much banks obviously took from that program, but there's also other factors at play, with local currency strength. And, absolutely. Okay. And what about, because obviously there's a lot, if I'm not mistaken, there's sort of 80 billion roughly of redemptions coming up in the second half of this year, and that's a fair bit higher than it was in the first half of the year. Do you think we'll see much refinancing, or for the reasons you mentioned, are we expecting a real tail off and those not to be refinanced? There's some of those deals coming up now.
Yeah, no, I think a lot of these redemption they have already been refunded. So even though the number is quite high on a historical basis, still I think the impact on actual issuance is limited. So given that most of the banks took so much cash out of the TLTRO, I think even though you have a lot of redemptions, doesn't change anything in for expected issuance.
Okay, yeah. And Henrik, does that sort of fit your assessment of how supply is shaping up?
Yeah, I mean, we expect much less supply this year compared to last year, but also compared to any of the last 5 years, pretty much. And already when we look year to date, supply is running far below last year. I think we are around 30% below last year's supply on aggregate level, and if we only look at the Eurozone issuers, it's probably closer to 50% below last year's issuance. And also, I think the composition of the issuance is interesting, because the issuance that we still will see from the Eurozone issuers will probably be very concentrated in the long end of the curve. So we will see 10-year or longer deals, because that's really where covered bond funding still can make a difference, because you cannot get that long maturity on the TLTROs, and also it might be difficult to issue unsecured bonds with such a long maturity. So the 10-year plus area, the issuance that we will see, I think, will be quite concentrated in this maturity area, especially from the Eurozone issuers. And then if we look outside of the Eurozone, I think there will not be much issuance there either, because they have already been quite active. If you look, especially in Canada, for example, there we had already quite a lot of issuance during the Corona crisis. So they definitely not need to issue just to show some presence in the market.
Absolutely. Okay. Then that's very interesting. So we've already seen a bit of a trend towards sort of these longer maturities being issued. You expect that will continue then? Is that having much of an impact on valuations and the shape of the curve as well? obviously not as much supply at the short end.
Yeah, I mean, I think we will see, especially from the Eurozone issuers, we will see more supply in the longer end of the curve. And I mean, for us as investors, we just need to, look into it and see if it's attractive. And if it's not attractive, then we have to find something else to buy. But I mean, the problem in general, the way we see it, or I don't know if it's a problem, but I mean, the spread curves are very flat at the moment. So we don't see much value in these long covered bonds. We prefer the shorter ones, but there is no supply in euros. But then, as I said before, then instead we need to look into our other currencies. For example, Swedish krona, Danish krona, where you still have a lot of issuance in the 5-year area of the curve. And also there are also coming some covered bonds in British pound and even US dollar. Maybe we'll see a little.
Okay, yeah. So a case of sort of looking more creatively at the market and trying to find new opportunities elsewhere as well.
Yes, definitely. Yeah.
And Julien, are you hearing? What's your picture on the DCM side of things? Are issuers interested in doing these long maturities? Are we seeing? Do you think we'll see issuers pushing out on the curve and trying?
I mean, here again, I fully agree with Henrik. It's as well the message that we get. Okay, if covered bond funding is interesting for us, that's the issue of view, especially from the Eurozone, then only in the long end, because the short-term money is already done with the TLTRO for most of them. And I mean, another factor which plays a role here as well is, of course, the low interest environment. I mean, a couple of investors, or not only a couple, a lot of them say we still try to buy something in a positive yield territory. And I mean, you have to go longer to reach this target, and with covered bonds, it became quite difficult to find something, at least when it comes from core Europe, below 10 years. And therefore, yes, some investors are looking forward to get some longer duration into their portfolio, but it's not possible for all of them to invest into 15 years, for example, especially a lot of more regional banking treasuries. Most of them are still limited, maximum 10 years. I mean, there are, of course, exceptions, but if you then have the requirement that you need a positive absolute yield at the end of the day, you don't find that much material out there.
Absolutely, yeah. Okay. And so obviously that was a trend going into the pandemic. We saw people pushing away from negative yields by issuing longer. I'm presuming that just the way that interest rates and spreads have unfolded recently, the question of negative yields has only become more. We're going to push more and more negative. Do you think that'll continue to impact what the sort of demand that we'll see for covered bonds, or as you mentioned, bank treasuries being a big part of the market, but maybe not being able to issue on 10 years? Do you think we'll see sort of a switch in the investor base at all, or?
Yeah, well, I mean, I would say still the biggest covered bond investor base is somehow in terms of size, and as well on the number of investors are banking treasuries. As said, I mean, it's not for everybody the case that they need a positive absolute yield. Yeah. Given there are as well a lot of them were saying, okay, no, I don't need a positive yield, but at the end of the day, I need a positive swap versus the mid swap rate. So at the moment, you still get this with covered bond issuers, even from core Europe. But the negative rates are more harming, I think, at the end of the day, the real yield investors like insurance companies, as well partly asset managers. And here again, even though you go to tenors of 50 years, so not talking about covered bonds only, but even looking to the SSA space, the absolute rate you get, it's difficult to get a quality issuer with 1%, even though you go up to 100 years. I mean, it's possible, but here again, you taking a lot of duration risk into your portfolio. And I think that is making the world difficult, not only for covered bond investors or the classical covered bond investors, but even for the whole investment community, which depends on high grade investments.
Absolutely. Okay. So yeah, even if you see very long issuance, it's not necessarily giving the rewards because of the shape of the curve.
Yeah.
Something.
Yeah, as just Henrik said, I mean, it's not that you have a very steep curve as well when it comes to spreads of covered bond issues. It's rather flat. So yes, you get some additional yield by adding some duration on it, but it's not that you see a massive game changer there.
Yeah, absolutely. And do you have anything to add on the question of sort of negative yields, Henrik? Obviously, you talked about.
I mean, we try to not focus on the negative yield because it's a bit depressing, first of all, and then our investment process is very focused on relative value. So it's not like we don't exclude any issue or jurisdiction just because the yield is negative, and not because the spread is negative either. As long as I mean, if -1 can still be attractive for us if the alternative is trading at -6, for example. So it's more the relative pricing, both in terms of spread and yield, that we try to focus on. But I think also what will be interesting here this autumn, because I agree the bank treasury community is really the key to keep covered bond spreads where they are right now. I mean, they bought around 50% of all covered bonds in 2019, and I think they are close to the same number so far this year. And now in September, when this issuance of the EU bonds will kick off, I mean, this will be a type of competition for covered bonds. So it will be interesting to see if bank treasuries, they are tempted to buy these EU bonds and instead reduce the purchases in covered bonds when we get these EU transactions going through. I mean, so far, if we look at the Berlin-Hyp this week, there are no signs of that, but I think it's something to watch here in the autumn, given the enormous amount of bonds that the EU is going to issue going forward.
Absolutely. Okay. So, and that would have a serious impact on covered bond valuations, I presume.
I don't think it will have a serious impact, because the ECB. I mean, the ECB is still putting in orders of 40% in each deal, and they only get an allocation of maybe between 15 and 20. So, I mean, what would happen if the bank treasuries they buy less is that the ECB will just get a larger allocation. So I mean, so to start with, I don't think there will be much impact on spreads, but it's still interesting to monitor I mean, to see how the bank treasury community will look at these EU bonds when they come to the market.
Absolutely, yeah. Okay. And Julien, I presume obviously that's a question on your radar. When the EU becomes an issuer this fall, and obviously, well, I suppose it's going to issue even more beyond in 2021. What are you kind of expecting for the impact on covered bonds there? And are you also sort of concerned about perhaps the exodus of bank treasuries away from covered bonds and towards this new form of debt?
I think it's definitely a threat. I think the impact on this year will be rather limited, given they will only start in September. Markets are cash rich, but then it comes again. I mean, what Henrik just mentioned, the relative value aspect. Just taking the week after issuance recap after the summer break, you had Berlin-Hyp with a 10-year at a +6. In the same week, you had a KfW with the same tenor at a -5. I mean, we still have 11 basis points in between. But if this spread is narrowing, of course, people can ask, as Henrik just said, the relative value question. I mean, for banking treasuries, the EU bonds will be 0% risk weighted. It's still LCR1. I would say as well that the liquidity in secondary market, given the size of these issuance, will be higher. And I mean, this could have as well an impact. Of course, you still have the ECB, which is supporting the current spreads of covered bonds. But if more and more investors are leaving this asset class to look for something else, that could have an impact. As said, I think the threat this year is limited. But with 2021 and the anticipation of a very high issuance volume by these institutions like the EU, that could have an impact as well on covered bond spreads.
Okay, so we might see some impact in autumn from the issuance, but maybe it's not worth reading too much into it because there's even more to come, and we could see.
Yes, I think as said for this year, my view is that it will be rather limited, given that I think the latest figures are they're anticipating roughly 30 billion until year's end from the European Union. There's so much cash outside, I think that will be more or less easily absorbed. But then again, here we have to see at what kind of levels they will come to the market. If they pay a little pickup versus what we saw this week from the EIB and KfW, you're not that far anymore from fund brief level.
Absolutely. Okay, but you know that there is still a decent pickup in covered bonds over SSA's public sector issuers. That's right. But has that been narrowing, that gap? And
I think we are more or less at the same level that we saw before the crisis. Nevertheless, even before the crisis, depending on which jurisdiction you're looking at, it's already from a historical perspective, it was pretty close to each other. So if you compare the German Bundesländer segment with Pfandbriefe, if you look to France, if you are comparing what the agencies are paying there versus the French covered bond issuers, I think most of them are already paying more. So at the end of the day, I think it will depend on the assessment of the investor community where they see more value.
Yeah. Okay. Well, Henrik, where are you seeing a lot of value over public sector borrowers, and in which sort of regions? What borrowers are you looking at?
Yeah, I mean, if we look at the core jurisdictions, if we take France, for example, there I still think that covered bonds have quite good value here, especially versus underlying government bonds, but also especially now after the tightening that we had in the SSA segment here during the summer, I think also relative to SSAs, and that's because the supply picture is so much different between government bonds and covered bonds, because I mean the ECB is buying both government bonds and covered bonds, but so the demand side from the ECB is quite equal, but on the supply side you just have an enormous amount of supply of government bonds, but on covered bonds the supply instead is actually running far below last year. So with that picture, I think if you can get 15-20 basis points in pickup on a French covered bond compared to a French government bond, that's I think that's I don't say it's not a fantastic level, but I don't think it's expensive. So given the so different supply picture between the asset classes, I think the value, if we look the next 4 or 5 months, is quite good here in covered bonds relative to government bonds especially, but also partly to the SSA segment.
Okay, but so are you expecting valuations in the public in the SSA market to widen on the back of the supply that you mentioned? Obviously, governments spending much more money to address.
Yeah, because I think the SSA segment is more of a substitute to these EU bonds, and also the whole semi-core government bond area. So if we take French OATs, Belgium, Austrian government bonds, and the SSAs that are issued by these jurisdictions, I think they are much more a substitute for EU bonds than covered bonds are. So if the EU bonds they will come at attractive levels, I think it's more likely that investors will sell French government bonds and buy the EU bonds than that they will sell French covered bonds to buy the EU bonds, because it's more. I mean, they are both 0% risk weighted, and I think covered bonds are at least partly placed with other types of investors, while the investor groups in SSAs and EU bonds, they are pretty much the same. And then there is also the liquidity issue, that you have better liquidity in the, of course, much better in government bonds, but also in SSAs to some degree. And then, I mean, just the supply situation as well, where you don't get much supply in covered bonds. So that will also, it will at least it will help to prevent covered bonds from widening relative to the government bonds and the SSA segment.
Okay, yeah, and I mean, you mentioned sort of core and semi-core. What about the periphery then? Is it a similar picture?
Yeah, I think, I mean, if we take the EU issues, that's why I see the most impact on the semi-core jurisdictions, since I see them as more a substitute for EU bonds. So you have bonds, on the other hand, those there I'm not so concerned, because the bonds is a little bit another type of asset class, and then the periphery on the other side, I'm not so concerned about either, actually, because those investors that are buying peripheral bonds, they are not the same type of investors that are buying French government bonds today, or French covered bonds, and then you also have, I mean, the supply pressure on the periphery is reduced due to this recovery programs that the EU is launching. So you are transferring issuance from the periphery to the middle, I mean, to the semi-core jurisdictions, basically. So I would say I'm more concerned about these the segment in the middle. So I mean, semi-core government bonds, EU SSAs, and to a small degree also covered bonds. But I think especially for the rest of this year, the impact on covered bonds will be quite limited, due to that we will not have so little supply.
Right. Okay. Yeah. And Julien, what do you make of that then? Do you think are you also expecting a similar impact, I suppose, from towards the semi-core more than perhaps the core and the periphery?
No, absolutely. I think, and as Henrik just pointed out, you have bonds, which is a kind of the reference mark for every pricing you have, more or less, because it's the most expensive asset you can buy in the fixed income world at the moment. And then you have the periphery. So both of these types have their own investor class. And yes, and then you come to the semi-core, where I think the ability of investors to switch maybe between the SSA and as well looking at other asset classes is of course higher. And therefore, yes, I agree with Henrik that there you can see potentially the biggest impact on the SSA side. Certainly on covered, that has to be seen. I think, as just pointed out, this year the supply will be so limited, and I mean, yes, covered maybe from a historical perspective versus Pfandbrief, when you look to the semi-core, looks pretty expensive, but nevertheless, if you don't have that much material available, you get a small pickup versus the most expensive covered bond asset class, the Pfandbrief. It's interesting for some investors as well. Therefore, in my view, for this year, covered bonds, even from semi-core, will be less affected. I think that's more a kind of government SSA problem. But hey, let's see how it will look in 2021, when issuance pattern will get maybe a bit more to normal years. How the effect will look there, because then potentially you would have a widening risk rather than these regions as well on the covered side.
Okay, yeah. Would you agree with those comments there, Henrik?
Yes, pretty much. Yes. Yeah.
And so obviously we talked talking about, well, I suppose how valuations in the covered bond market could be shifted from below in the risk spectrum, the public sector borrowers. But what about on the other side? So other forms of bank funding. Is there how do valuations in sort of the preferred senior market? How will they impact covered bonds, do you think, going forward? What's the sort of differential looking like, and is it attractive enough to sort of encourage investors into perhaps riskier asset classes?
Yeah, I think that the preferred senior segment, because I mean those investors that are very focused on yield levels, I mean they will be tempted, I think, to switch from covered bonds into preferred seniors, and because the spread levels there are so squeezed and so tight in covered bonds, it might be that those investors that have a mandate to do so, that they sell covered bonds and move into the preferred senior segment to get some pickup. But that said, I mean, the additional pickup is not that fantastic. I mean, all because spreads on preferred senior is also very tight. But you can, of course, get some pickup by doing this. But I think what limits the amount of switching that we will get in this direction is that it's much more difficult, in my view, for a preferred senior to trade at negative yield than it is for a covered bond to trade at negative yield, because you cannot repo fund the preferred seniors at the same levels as covered bonds. Because if you are running a product where you have some leverage, there it can still be attractive to buy a covered bond at -10 if you can repo fund it at -35. Then you still have a pickup. But this you cannot do with the preferred senior. So that's why I think that it's limited how much the preferred senior can tighten versus covered due to this reason. It's only these long-only investors that only look at yield that can tighten this spread to some degree, and a large part of the covered bond investor community today are not long-only investors. So it's quite. I mean, I don't have the full picture and I don't have the numbers, but I think it's just a small part of the larger investor community in covered bonds today that could move into preferred senior, and therefore also the impact will not be that. I don't think we will see that much spread tightening between the two segments.
Okay.
At least not at these yield levels. It's another thing if all yields suddenly would be 100 basis points higher, because at higher yield levels, I think you could see more spread tightening between preferred seniors and covered bonds. But as long as we are at negative yield levels in covereds and close to negative yields in preferred senior, I think it's difficult to see much more spread tightening.
Okay, yeah. I know the covereds will be driven lower by its investor base, and if there's a floor on preferred senior yields, you know, at sort of towards the negative rates, that won't eventually have an impact the other way on covered bonds, pushing them wider, you don't think?
No, and not as long as you can. I mean, as long as you can repo fund them very close to the deposit rate, then I mean, because we have the same type of investment products ourselves, and if we can repo fund the AAA covered bond at -35, -40, then it's still attractive to buy them if they trade at -15, for example.
So
yeah.
You wouldn't be tempted into the preferred senior asset?
No, because I mean, if I include the repo level, then I actually get a lower spread on the preferred senior. So in all those type of products where you use repo funding, it's not attractive to switch into preferred senior due to that the asset class has a worse ranking regulatory.
Absolutely. Okay. And Julien, does that really fit the picture that you're seeing as well with investors you speak to? Are we actually seeing much of a switch towards preferred senior from some funds, or is it?
Yeah. Well, I think the important point Henrik just mentioned is the absolute yield level you have at the moment, where to my knowledge, there are only a very, very limited number of investors who would be willing to buy senior preferred at a negative rate. However, what we saw, especially during the summer break, given that there were no issuance, or even in the private placement segment, there was no covered bonds available at the short end of the curve. We saw even from a lot of regional, so from savings banks and cooperatives, we saw a couple of private placements where they switched the money into senior preferred, especially at the short end of the curve. a couple of them just made a trade-off. I mean, you can get TLTRO money for 3 years at a certain rate. You invested into a higher yielding senior preferred. I mean, even though you can't refund it at the same repo rate like you can do for covered bonds, it's still ECB eligible, so you can hand it in there, even though it's not the same rate certainly, but you get a kind of I wouldn't say arbitrage, but nevertheless it makes sense from an investment point of view. But yes, Henrik is fully right. It doesn't apply to the vast majority of the covered bond community that they can easily switch to senior preferred bonds. I mean, for a couple of banking treasury, it makes sense. But nevertheless, you have the investor community for covered bonds, and well, only a small portion will make the switch into senior preferred as long as you get a final interesting yield on it. But here again, if you look on the spread difference you have at the moment and what it means in absolute terms, it's not that super attractive for the vast majority.
Absolutely. Okay. I just wanted to remind anyone listening that you can type questions into the chat function and they will be addressed in this panel discussion. I just also wanted to just move on just to talk about cover pools and the nature of risk there and how that's changed during the pandemic. I was just wondering whether certain types of covered bonds were perhaps faring worse in recent months just because of how how COVID looks like it's shaping up and taking its toll on the economy. I'm thinking sort of that certain types of loans in cover pools are probably more likely to become impaired, and maybe commercial real estate. How are these sort of factors developed in recent months? Do you think that is there divergence in cover bond trading along the lines of what cover pools look like, or is it more homogenous than that?
Yeah, I mean, we don't see any impact at all until now due to the cover pool composition on the pricing. So I mean, until now, I don't see this crisis as first of all, it's not even a banking crisis. At least it doesn't have its roots in the banking industry, and it certainly doesn't have its roots in the covered bonds or cover pools. The question is if something can change going forward, and I mean, for us, we are looking at especially two factors. First, you have the commercial real estate sector, where there are I think we will see some pressure due to some changes in society that might continue even after the corona crisis. And one of them, it's all the remote work that we are doing and also doing right now during this conference. And that's, in our view, clearly negative for commercial real estate, especially in large cities, because I mean, I think it's likely that people will continue to work from home also after this crisis, just because they have discovered that it's much more convenient, and companies have discovered that they can save a lot of money on expensive office space if they have 20% of their employees working from home. So that's the first thing that will put pressure on the commercial real estate sector. And then the second one is the move towards more and more e-commerce, and this will probably, and it has already accelerated due to the COVID-19 crisis. So more and more shopping is done online, and this will also, I mean, this trend was already in place prior to this crisis, but it will continue to put pressure on retail stores, especially in large cities where the rent is very high. So we are looking at these cover pools with a lot of commercial real estate in the cover pools, and I mean, until now we cannot see any impact on the pricing, but that's because ECB is buying such a large amount of bonds, but it might change in the future. And then the other thing we are monitoring as well is all these payment holidays that has been introduced across Europe, where people can stop paying on their mortgage for some period of time. If you become unemployed, for example, but also in some countries you can even get this payment holiday on the mortgage. You can just ask for it and you will get it. You don't even have to specify why you want to have it. And this varies quite a lot from country to country. And if we look at the cover pools today, we can see that these amount of deferred loans due to payment holidays, they vary quite significantly from country to country, but also from bank to bank within each country. It varies quite a lot. So that's also something that, I mean, until now, we cannot see any pricing impact from this either. But it's certainly something that we will continue to monitor. And I mean, given how the banks will handle these payment holidays going forward, it might be that it will be an issue going forward. It depends also on of course, how much over collateralization there is in the cover pool, because if you have a large amount of deferred loans and low over collateralization, then you are, of course, then there is a larger risk that it will have some impact eventually on the spread levels.
Okay, yeah. So there's plenty of reason to be cautious about some of the cover pools, given some of the factors you've identified. But
I think it's always, at least it's factors that are important to keep and to continue to keep an eye on.
Yeah, absolutely. Okay. And Julien, do you have anything to add on those points? Obviously, obviously there's going to be risks to certain types of loans and in certain jurisdictions, perhaps more so than others in the cover pools, but maybe not. We're not seeing this reflected yet in the way that the market is trading.
Yeah, no, absolutely. I think it's not reflected in the market at all. I think at the moment the price differences you see, it's more based on a kind of jurisdiction perspective. So if you have a German fund brief, or if you have a Finnish covered bond, I think that's where the price difference at the moment is. But I fully agree with Henrik that of course which will be the most affected will be all the cover pools that have commercial real estate inside. You mentioned the office spaces, the shopping centers, and one factor, as in my view as well, will be hotels. Just for the simple reason, I mean, I believe even if we're getting back to normal, we all find out that this kind of virtual conferences or virtual or conference calls works pretty good. So yes, and especially big cities where you have a lot of business people traveling to will still enjoy these people looking for hotels, but I think it will be less in the future. And therefore, of course, you have another asset class. It's maybe the wrong word, but I think these kind of buildings where you have hotels inside can suffer as well in terms of pricing. And that's certainly something you have to watch. And but at the end of the day, it's a kind you have really to do the individual valuation on the cover pools, because if you have a high level of over collateralization, you have a strong credit which stands behind the cover pool. I think all the investors who are invested there will be good off. And I think at the moment we don't still see the whole impact on the crisis. I mean, you had a lot of payments which were deferred at the moment. Banks said, okay, you get a break for the payments for a certain period. It's the same when you look at the insolvency rate in many countries. You didn't see a high rise, at least not here in Germany, which is as well due to the support by government. And if at a certain point of time this will stop, I think we'll see the real impact that COVID-19 had on the respective economies.
Absolutely. Okay. Well, unfortunately, I think we've run out of time. But thank you both for such an interesting discussion. It's been a pleasure to speak with you today, and thank you also to everyone that has dialed in to listen to this panel. So thank you very much. I hope you've enjoyed it as much as I have.
Thank you.
Thank you.